Hello, members of the Air Canada Board. My name is Jeremy, and myself, Marina, and Richard, my teammates, will now discuss our findings related to your risk management strategies and recommendations for the future. Kaylin Rovinescu, your CEO, is in the process of reviewing your company's risk management program and has asked whether the current policies are appropriate given the current economic and industrial ecosystem that you are a part of. Our report will first assess the existing landscape for Air Canada. We will then identify and assess the most relevant financial risks faced by your firm, how you manage these risks, and perform a similar analysis for your largest rival, WestJet. Finally, our assessment will be used to provide recommendations to the board, regarding Air Canada's risk management policies moving forward.
Yeah.
The general business environment for Air Canada, as can be seen in our SWOT analysis on the slide, is one of uncertainty and volatility. Over the previous decade or so, the airline sector was hit with a plethora of challenges, beginning in 2001 with the terrorist attacks on the World Trade Center. Currently, the challenges have evolved and varied with global economic conditions and customer preferences and emotions. The 2009 financial crisis made the status of the global economy very uncertain. It caused passenger air travel to decline and financing to become harder to attain. However, there was a silver lining in that fuel prices went down. Also, the costs associated with the airline industry have been volatile and increasing, in addition to several other sources of uncertainty for the industry. Despite increasing competition and this volatile economy, industry performance improved in 2010, and future consumer spending on airline travel is optimistic. Customers are becoming more comfortable with paying for extra services, which creates larger ancillary revenues for airlines, as is seen in this graph. Air Canada's corporate strategy has shifted as a result of the current industry environment. Whereas the strategy was formerly centered around cost and capacity reductions, as well as managing pension solvency and labor contract risk, it is now focused on four elements: expanding international operations, generating incremental revenue and significant cost savings, refocusing on customer service and the promotion of your premium cabins, as well as fostering a culture of change. The composition of your board is diverse and allows you to be competent in nearly every aspect of Air Canada's daily operations. However, 4 of 10 board members have been here for 2 years or less and are likely not as well versed on the firm's key issues and risk management techniques as some of the other members. Future challenges for Air Canada are numerous. They include future volatility in fuel prices, a changing global economic environment, increasing competition from smaller, low-cost airlines, low-frequency catastrophic risks and higher-frequency operational risks, as well as several financial risks which will be discussed by my colleague Richard in the coming section.
Thank you, Jeremy, for the kind introduction. The most relevant financial risks facing Air Canada are market risks. A large proportion of the aviation giant's expenses are not predictable due to the volatile nature of commodity prices, interest rates, and the foreign exchange market. Air Canada must place paramount attention to the risk of increased fuel costs and increased interest rates. A slight rise in either the price of fuel or interest rates could be the difference between our profit and loss. I will discuss fuel price risk, interest rate risk, liquidity risk, foreign exchange risk, and the risk of Air Canada's performance share units. The cost of fuel is a vital risk to Air Canada. Prior to 2003, the price of fuel was not the primary concern for the aviation industry. In the early 2000s, depressed energy prices resulted in lower fuel expenses for the industry. On average, in 2002, fuel expenses totaled a mere 13% of operating expenses for the world's major airlines. The airline industry remains to bear the consequences of the early 2000s oil shockwave. As this graph depicts, the price of jet fuel has increased significantly since 2003. In consequence, airlines incur annual fuel costs between 20 to 30% of all expenses. The volatile fuel market is a substantial risk for Air Canada's performance because it makes it a challenge for us to predict our expenses and the revenues we need to attain a profit. Air Canada mitigates the risk of increased fuel prices by purchasing derivatives. Regarding fuel price, the firm's risk policy is not very risk-averse, and Air Canada has no minimum hedge requirement. In contrast, the risk policy imposes a limit to the extent that Air Canada can hedge fuel prices. we can hedge to a maximum of 75% of fuel purchases for the upcoming 12 months, 50% for months 13 to 24, and 25% for months 25 to 36. Air Canada estimates forthcoming fuel prices based on the anticipated market conditions and purchases derivatives in response to its projections. Air Canada's 2011 fuel price estimate is US 80 cents per liter. To cover its exposure to 2011 fuel purchases, Air Canada purchased capped call options that cover 4,580,000 barrels of crude oil. The call options are capped at US $94 a barrel and hedge 20% of 2011 fuel purchases. Since only a fraction of the airline's upcoming fuel purchases are hedged, Air Canada remains sensitive to the volatility of the commodity market. Interest rate risk is another relevant risk for Air Canada. The prospect of rising interest rates is a risk because the majority of Air Canada's debt contracts are floating rate arrangements with a syndicate of creditors. A consequence of floating debt contracts is that Air Canada's creditors can increase the interest rate on the debt at their own discretion. Rising interest rates can cause a significant cash outflow because Air Canada's interest expense is often greater than its operating income. Air Canada uses several hedging techniques to mitigate the possibility of rising rates. Its primary interest hedging method is to purchase interest swaps that convert floating rate debt to a fixed rate payout schedule. Air Canada has a long-term target of 60% of long-term debt at fixed interest rates and 40% at floating. The 60-40 ratio is, however, quite flexible, and Air Canada adjusts its capital structure according to market conditions. In 2010, 69% of its debt, after considering the effect of interest rate swaps, was fixed, while the other 31% was floating. In addition, Air Canada utilizes natural hedges to mitigate interest rate risk by investing its temporary investment portfolio at a floating rate. If rates increase on its debt, the effect of the increase will be partially mitigated because Air Canada will receive a higher return on its short-term investments. The possibility of rising interest rates is moreover connected to Air Canada's liquidity risk. Although Air Canada did generate a $107 million profit in 2010, there still looms the prospect that we will not have sufficient cash to meet our short-term obligations. At its 2010 year-end, the airline's current liabilities totaled upwards of $3 billion. To hedge the risk of falling short on its financial obligations, Air Canada prepares rolling cash flow forecasts, monitors the value of its assets that can be sold to recoup the cash to pay its creditors, and seeks to achieve unrestricted cash balances equal to or above 15% of operating revenues. In 2010, Air Canada's unrestricted cash balance exceeded the 15% target by 5%, and we held over $2,192 million in cash and cash equivalents. The consequences will be very significant if Air Canada experiences liquidity shortfalls in 2011. While it could sell assets to recoup cash, this will likely create a public relations disaster, reduce employee morale, and compromise the airline's ability to generate positive financial returns, as our assets exist to facilitate our performance. Another option would be for Air Canada to renegotiate its debt agreements with its creditors or ask them to refinance the debt obligations. Neither of these options are ideal because they will make it more likely for our creditors to request higher interest rates during future financing negotiations. Foreign exchange risk is a relatively unique risk to Air Canada. Unlike its American competitors, Air Canada's revenues and expenses are denominated in different currencies. While Air Canada earns revenue primarily in Canadian dollars, a significant amount of its expenses, including fuel, aircraft rental, and maintenance charges, are payable in US dollars. A relative appreciation of the US dollar would weaken Air Canada's financial strength and increase the fair value of its expenses. Air Canada uses both natural hedges and derivative contracts to mitigate the risk of a weakened Canadian dollar. All of Air Canada's non-Canadian revenue is converted to US dollars. This natural hedge covers 29% of Air Canada's foreign exchange exposure. Air Canada therefore remains exposed to a weakening of the Canadian dollar. A short-term rise in Air Canada's stock price is, surprisingly, a risk for Air Canada due to its performance share unit compensation program. At year-end, Air Canada had approximately 3.58 million PSUs outstanding. If Air Canada meets its earnings targets over a 3-year vesting period, these PSUs entitle employees to receive one common share, or its fair market value cash equivalent per vested unit. 825,000 PSUs vest in 2011. Air Canada has hedged 75% of its exposure to PSUs vesting in 2011 and 2012 by purchasing forward contracts on its own shares that expire when the respective PSUs may vest. Our sensitivity analysis must be taken with caution. The following estimates for fuel price and foreign exchange volatility are based on Air Canada's financial analysis of how a change in both input prices would have affected our 2010 earnings. We would suggest these 2010 estimates are a reasonable parameter to predict Air Canada's sensitivity to both fuel price and interest rate hikes in 2011. Each 1% increase in the price of jet fuel, as measured in Canadian dollars, or 1% depreciation of the loonie to US dollar exchange rate, will cost Air Canada an estimated $24 million of operating income. Air Canada's auditor, PricewaterhouseCoopers, has conducted a sensitivity analysis of the risk of rising interest rates. PwC projects that each 1% interest rate hike will reduce Air Canada's 2011 income by $2 million. I will now turn to Marina to discuss our relative strengths compared to our competitor, WestJet.
Thank you, Richard. I will now provide an overview of the risk management strategy that is used by WestJet, who, as we know, is Air Canada's largest competitor. Now, in this section, we have narrowed our focus to 4 risk categories, which are fuel price risk, foreign exchange risk, interest rate risk, and liquidity risk. We feel that these categories warrant discussion in relation to WestJet because they do represent areas in which WestJet's risk management strategy does differ materially from that of Air Canada, and this could render Air Canada at a relative competitive advantage or disadvantage as market conditions change. So we'll start off with fuel rate risk. We learned from WestJet's 2010 financial statements that the company had hedged 20% of its upcoming 2011 fuel requirements. They hedged using call options and collars, and as you can see on the screen, WestJet purchased WTI crude oil call options and jet fuel collars. So I will explain the difference between those in just a minute, but for now it is important to note that WestJet purchased derivatives using both crude oil and jet fuel. So next we will see the specifications of Air Canada's fuel hedging program. We can see that Air Canada has also hedged, as Richard mentioned, 20% of its anticipated 2011 fuel purchases. Air Canada also uses a combination of call options and collars, but it is important here that Air Canada has only hedged using WTI crude oil based options. So both of its call options and collars are crude oil based. WTI stands for Western Texas Intermediate, which is a grade of crude oil that is commonly used to benchmark oil prices in North America. Jet fuel has very low liquidity, and airliners thus very commonly use crude oil instead to hedge their jet fuel purchases because crude oil is much more heavily traded. Crude oil is a suitable substitute for jet fuel hedging because they're very related products. Jet fuel is a byproduct of crude oil, and the prices are generally quite correlated. Other similar substitutes with a higher liquidity than jet fuel include propane and heating oil. And you can see on the screen a graph that illustrates the relationship between the prices of propane, jet fuel, and crude oil over, I believe, a 4-year period. It is important to note from this graph that the relationship between WTI crude oil and jet fuel does fluctuate over time. So at times, such as early 2009, the two are very highly correlated, and at other times the gap in the prices does widen considerably, and we can see a spread. Therefore, hedging only WTI options, as Air Canada does, may prove to be a risky strategy if prices diverge in 2011. Now, the prices might diverge due to any number of factors, such as changes in refinery capacity and variations in demand. So by including pure jet fuel calls in its 2011 portfolio, which WestJet does, WestJet increases the chances that its hedges will ultimately well correspond to the actual prices of jet fuel. So we will now move on to foreign currency risk. WestJet's financial statements indicate that the company is very similar to Air Canada, vulnerable to exchange rate volatility in its operating expenses, which include fuel and aircraft leasing costs, which are paid for in US dollars. WestJet uses USD denominated cash reserves and short-term investments, as well as foreign forward contracts to hedge against this foreign currency risk. So at their annual general meeting in May 2010, the company indicated that the entirety of their USD debt payments and 90% of their upcoming leasing costs are fixed in Canadian dollars using forward contracts. So as Richard previously mentioned, Air Canada has only hedged 29% of its US denominated expenditures using natural hedges, and therefore we can say that Air Canada would be at a relative competitive disadvantage to WestJet if the Canadian dollar weakens relative to the American dollar due to the fact that WestJet has hedged more of its expenditures. We'll now move on to interest rate risk. So WestJet's 2010 statements indicate that the great majority of its long-term debt is set at a fixed rate. So they only have 0.06% of their long-term debt at a floating rate currently. Now, this is a rather sharp contrast to Air Canada's split, which, as Richard mentioned, is generally 60-40 fixed floating, and at the moment it is 69% fixed and 31% floating. So WestJet's strategy can definitely be said to be more risk averse. They will be at a competitive advantage, certainly, if interest rates go up. However, WestJet's strategy does appear to lack flexibility. I mean, Air Canada's just try to change its structure with changing market conditions, and WestJet will be unable to enjoy a level of benefit if the interest rates go down. So without knowing which direction the interest rates will go in the future, it is difficult to say which strategy is at a competitive advantage over the other. Finally, with liquidity risk, WestJet statements specify that the company aims to have enough cash and cash equivalents to meet 100% of their current liabilities. So they measure their liquidity using the current ratio, which is simply the company's current assets divided by their current liabilities. WestJet aims to have a current ratio of at least 1, and at December 31st, we can see that they have exceeded this goal and they have achieved a high current ratio of 1.52. So we calculated Air Canada's current ratio using their current assets divided by their current liabilities. You can see that on the screen, and this renders a current ratio of approximately 1.12. So comparing these two ratios, we can see that WestJet is in a preferable liquidity position and is less likely to be unable to meet its financial obligations than Air Canada in the coming year. Now we will move on to the recommendations. So for our first recommendation, we recommend to Air Canada to diversify its fuel-related commodity hedging beyond only WTI crude oil-based options as it currently has. By including jet fuel hedges in its portfolio, as WestJet does, Air Canada can protect itself from any future divergences that may occur between the price of jet fuel and crude oil. It is worth noting that jet fuel is not very liquid, and it may be difficult to do this. A significant portion of Air Canada's fuel hedges will likely still have to consist of substitutes and will carry some degree of risk. The goal then is to minimize potential hedge losses by choosing the derivative commodity with the highest correlation to the price of jet fuel. There is some empirical research you can see on the screen that shows the correlations between different substitutes and the price of jet fuel. As you can see here, heating oil actually has the highest correlation over a 10-year period. So we recommend investing in both WTI and heating oil options as well as jet fuel options, and thereby diversifying Air Canada's exposure.
Secondly, Air Canada should increase their emphasis on foreign exchange risk mitigation strategies. Currently, only 29% of their foreign currency risk is hedged, leaving them quite exposed. Air Canada can mitigate its foreign currency exposure through several methods, like forward currency contracts, currency swaps, and increased natural hedging. Alternatively, they can also take on a strategic shift whereby they relocate more core operations and resources to the United States in order for them to increase their U.S. revenues and consequently eliminate some foreign currency exposure which they currently face. Third, since fuel prices are the most volatile and largest costs for the airline, Air Canada would stand to benefit from implementing a more thorough evaluation procedure for forecasting future fuel prices. Although the company currently performs some form of prospective forecasting, it does not seem to be as thorough as it can be, given the magnitude of this risk to the firm as a whole. Having a more complete evaluation process will further reduce their risk exposure to this aspect of their core operating model. A more detailed evaluation can occur, for example, through the hiring of either permanent staff or temporary external consultants to provide more educated or knowledgeable opinions on the matter, using historical information, assessing the amount and types of fuel that will be used, or assembling a small task force with the role of compiling a report on expected future trends in fuel prices and what can affect these predictions in the coming year. That's it.
Our next recommendation is for Air Canada to prioritize improving its liquidity position. As noted by Richard, there is certainly no easy solution for increasing liquidity. However, we do recommend that Air Canada conduct a thorough analysis of its expenditures and aim to improve its current ratio. Given the dire consequences of suffering a liquidity shortage, which were also mentioned by Richard, and also the relatively preferable liquidity position of WestJet, Air Canada's biggest competitor, we believe that this certainly warrants extra attention from the company.
Our next recommendation would be for Air Canada to improve the transparency of its risk management policy. In last week's fourth quarter conference call, Air Canada's CFO, Mike Rousseau, nudged the question whether Air Canada will follow WestJet's example to raise airfare fees in response to higher fuel prices. The CFO indicated that reducing air capacity and raising fees would be options for Air Canada if fuel prices continue to go up, but he did not mention the strike price that would bring about these measures. We believe that this ambiguity does not reveal a competent risk management policy. If Air Canada revealed the fuel price which would bring about these changes, it would send a positive message that the airline has adequately mitigated the threat of market volatility. Finally, we believe that it is a problem that not a single board member has direct experience with the Asian market. This is a problem for Air Canada since the Pacific region generated the largest revenue increase for the airline in 2010. Due to the high-yielding long-distance routes, the Pacific region is the cornerstone of the airline's growth opportunities. Having a board member with expertise on the region will help mitigate the risks of being greater reliant on Asian market revenues. Thank you very much for listening to our recommendations, and we look forward to hearing all of your feedback.